My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I got people make friends. I'm just trying to save you some money. My job's not just to entertain, but to educate, put in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Cracks. We're seeing some cracks in the armor of prospective earnings from some very important companies, and it is getting downright unnerving. We're now looking at the other side of what the Fed's been doing to stamp out inflation, and it's a big reason why the Dow lost 199 points, S&P shed 0.70%, and the Nasdaq tumbled 1.06%. We're going to have to learn to live with not a collapse in commerce, but definitely a slowdown, along with the decline in profitability that always comes at this particular point in the business cycle. Each day, we see more of these cracks. This morning, we got some extremely disappointing numbers from Southwest Airlines, symbol LUV, but there was no love. The airline's margins are being pressured by higher gasoline prices. It's not $2.50 or $2.60 per gallon. Its budget is $2.70, $2.80, which is a huge difference when you think about how much fuel these planes burn. Meanwhile, Southwest revenue per available seat mile, that's RASM, is down rather dramatically. We're looking at a 5 to 7% decline when the company previously said it would just be down 3 to 7%. That is jarring. Looks like business is finally getting hurt by these sudden rise in the formerly tame price of oil. It ain't tame anymore. It's up in a straight line. And you can't ignore the fact that Southwest revenue per available seat mile is coming down and coming down hard. That's a sign that the sustained travel and leisure boom might finally be coming to an end. We don't want that. We're a service economy, for heaven's sake. It's not our industrial might that's going to keep things going. It's been stuff like travel and leisure fueling everything. What if we lose it? At the same time, we got some news from General Mills that pet owners are becoming cautious. Their economic outlook's dimming, and they're shifting towards more value-oriented products for their pets. Not necessarily the forte of Mills Blue Buffalo premium products that we use for our dogs, Riga and Tony. I've always felt pet food was one of the more fungible items out there, and it can easily become a slippery slope. When things are flying high, your freezer and refrigerator filled with pet food looks like Green Giant and Hebrew National. Now the pets are getting the cans. Hey, not that they can tell the difference. They're always hungry anyway. I mean, what's the deal? New and improved. More cracks appeared last week when we got the usually reliable Dollar General, which they had way too much inventory. They missed the quarter badly, perhaps because their bargain sizes aren't as attractive as the deals you can get from Costco, where the premium brand is the house brand Kirkland, and business remains very strong. By the way, the fact that the stock of Costco is breaking out here is actually a bad sign for the stock market, as people know that you save a lot more at Costco and therefore your dollars go further. We see cracks where another one that is just like Costco. We got 2 price target boosts today for the stock of TJX. That's the parent of TJ Maxx and Marshalls, a company that only does this well when so many other merchants are struggling. Remember, TJX buys the unwanted excess inventory of brick-and-mortar retailers for next to nothing, then it flips it to you, the consumer, in a nice markup. It can be a vicious spiral for the rest of retail, because once you get hooked at TJX, you're not going back to those full-price joints. Not me, I'll tell you that. I got one right next door, and I love it. And we saw some big cracks at Walgreens last week when the CEO suddenly left. Rarely a good sign. You don't leave when things are on track. Plus, the pilferage at drugstores, it's like Walgreens, has become monstrous. It's now considered the cost of doing business at all retailers. They now need to lock everything behind lock and key, right? Have you ever seen that behind that glass? But what is that? Now, we don't have time for the court to come over with the key, but always feel bad about it anyway. And the only thing that seems locked is the name brand, not the house brand. Hey, that's how it looks in key aisles of my Rite Aid. So why not just go buy everything you need from Amazon, which has made same-day delivery an art form this year. You buy in the morning before you go, leave for work, right? It's at your doorstep when you get home. Kind of like what it's like with Walgreens, except for faster. And by the way, no one's stealing it. We see cracks in the banking system, too. No, it's not on the credit side like it usually is, but it's on the lending side. They need more capital to fight the last war, which was what Silicon Valley Bank and First Republic-style bank runs mean. How stupid. That wasn't a capital issue, regulators. It was an investment decision issue. But the regulators don't want to embarrass themselves again, so they decided to rein in the profitability of the banks, which means less credit for you in your Main Street business. Never mind that the horse has already left the barn. We see cracks in housing. Mortgage applications dipped 2.9% versus last week, we've learned today. No doubt because long-term rates are flying higher, with the possibility of mortgage money coming in around 9%. 2 years ago, my mortgage was 3.35%, and now I'm not going to go anywhere. Neither are all the other people with my mortgage vintage. Housing seems at last to be slowing down, and housing prices have been a thorn in the side of everyone, especially the Federal Reserve. But pulling that thorn with higher rates instead of more supply of houses hurts like the dickens. Unfortunately, Jay Powell can't force the home builders to put up new houses. He can only drive down prices by making it more expensive to borrow. Not a great way to solve the problem. We see cracks in autos. The car companies, sans Tesla, are facing what could be a major strike. The unions have a strike fund, which lasts a heck of a lot shorter than the pots of gold that the auto companies have saved. But the auto companies have been pumping out as much product as possible in case we do have a strike, which means they're going to get hurt either way. Think about this. If there's a strike, the production comes to a halt. They don't have enough vehicles to sell. If there's no strike, they'll have way too much inventory that they've built, and you'll see a lot of car ads on television during football season than you can recall. Probably get some good deals, too. We are in a lull for earnings, but during this period, we've seen a rise in the dollar. That takes away one of the biggest props from last quarter. Most of our companies that operate overseas benefit from weaker currency. 3 months ago, they had that. Now it's going to the wrong direction. New crack we didn't expect. And what's the government doing about it? Nothing. The Federal Trade Commission stepping up and going after Amazon for some of its practices that are allegedly hurting merchants. Let's say that's even true. I know there are good reasons to protect merchants. But right now, Amazon is one of the few institutions that's actively lowering prices for you. Only Costco's done more, and now the FTC is going after them. Thanks for nothing. Even if the FTC has good reason to go after Amazon for hurting merchants, and I'm not all convinced they do, couldn't they wait until after we got inflation in hand? The last thing we need is the government working to push up prices for all sorts of goods. Thank you very much, Lena Khan, head of FTC, for targeting a service that 65% of Americans rely on. Now let's take a step back for a second. Remember, September tends to be a terrible month, in part because many big funds have large gains. September's got close to enough to the end of the year that a lot of these managers will just take profits and go on vacation. Or a semi-vacation. Thanks to the September environment, all news gets magnified, particularly the bad news. We hear that the Chinese government might be saying to their employees they can't bring their iPhones to work. What does that mean for an amazing market for Apple? Shoot first and ask questions later. That's what it means. Governments are angry at mega caps. Don't debate it. Just sell them. That's what's happening. Bottom line, the real crack we saw today and what we saw yesterday is why I hate September. Too much goes wrong. Hence why the markets are typically down 0.7% for the month. The good news, we're already down that much. So maybe we'll start running out of downside soon, assuming the cracks in this market don't keep getting bigger. I want to go to Kevin in Georgia. Kevin.
Mr. Cramer.
Kevin, how are you?
Thank you for taking my call. Good, how are you?
Good. Wow, I'm thrilled that you called in. What's going on?
Thank you again for all that you do.
Thank you.
This stock is the go-to name when it comes to backup power solutions, and it's been mentioned on the show many times. But even Michael Burry's fund made an investment in this company in his latest 13F filing. After bottoming out at the end of 2022, the stock has shown some signs of life, but then got smacked back down after their recent quarterly earnings. In light of its bad earnings with tailwinds like hurricane season and an unreliable electric grid, what are your recent thoughts on Generac Holdings?
Look, I like Generac, but I have to tell you, I feel the same way, by the way, for some of these solar edge, some of these solar plays, Enphase. You need credit in order to be able to buy these big things, and that's what's causing problems, because the price of credit has gone up. People don't think of that, but that's what's driving them down. Let's go to Dennis, my home state of New Jersey. Dennis.
Booyah from Bedminster. Jim, how you doing?
Oh, come on, man. You're right around the corner from me. Good to have you on the show. What's going on?
Oh, first, I have to give a shout-out to my beautiful wife of 25 years married.
Well done.
I could. Thank you. And the stock I want to ask you about has a PE of about 15, even throws off a dividend of about 2%. It makes chips for many companies, including NVIDIA. And my average cost is $98. Should I buy more, sell, or hold Taiwan Semiconductor?
It's a great question. It's the kind of question we answer all the time for the Investing Club, which is that you're buying it too close to the last purchase. When you're trying to kind of average in like this, you don't want to just do it down 6. We like to think down 10% is the first level you should buy. So therefore, you got a few more points before I would put in the Not yet, even though I like the company very much. We're already down about as much as we normally are for the entire month of September. So maybe we'll start running out of downside soon, assuming the cracks of this market don't get deeper, although I have to tell you, I think they probably will. On Mad Money tonight, our team is holding our annual fantasy football draft later tonight, and while I'm not quite ready to announce who's my top pick, I'll share which stocks I think correspond with which positions and who I think you should be drafting for your stock portfolio. Then CrowdStrike defended itself against bears after the earnings. So what drove the strength of the quarter? Don't miss my exclusive with the CEO. And the FTC has its sights set on some of the biggest deals in the street. So how will it impact your portfolio negatively? I'll discuss it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.